90% of traders lose money. That's not a rumor. That's not a scary number thrown out by skeptics. It's the cold truth, confirmed across decades, markets, and continents. Imagine stepping onto a battlefield where 9 out of 10 soldiers never make it home. Would you run forward blindly, swinging your weapon in every direction? Or would you stop, scan the field, and search for the hidden patterns that separate the survivors from the fallen? Welcome to Trading Psychology Stick, where we strip away the noise and focus on what actually works in the markets. Quick disclaimer, everything I share comes from real market experience and observation, not financial advice. Your money, your decisions, your responsibility. Now let's dive into the war zone. The trading arena is exactly that, a war zone. The candles you see on your chart are not just green and red rectangles. They are volleys of arrows fired between armies of buyers and sellers. Every wick is a bullet that grazed someone's head. Every breakout a charge into enemy lines. Every failed level a fortress collapsing in smoke. And just like any battle, it's not the loudest, bravest, or most impulsive soldiers who win. It's the ones who know when to hold fire, when to retreat, and when to push forward with precision. Here's the trap most traders fall into. They believe trading is about constant action. They think the more orders they place, the more money they'll make. But on the battlefield, firing without aim just empties your ammo. In trading, it empties your account. Professionals don't spray bullets into the air. They wait, they study, they let the rookies rush out and get slaughtered. And when the dust clears, they move in and secure the prize. You might be wondering, if the odds are so brutal, why step into this battlefield at all? Because hidden inside this chaos is the possibility of freedom, the possibility of mastery, the possibility of turning the market from a monster that devours you into a weapon you can wield. But to do that, you must stop acting like a foot soldier chasing adrenaline and start thinking like a general crafting a campaign. This journey isn't about learning a dozen complicated indicators. It's about stripping away the noise until you can see the terrain clearly. It's about understanding the 4 kinds of battlegrounds the market sets up for you. It's about knowing which fortresses are worth capturing and which ambushes are designed to lure you into traps. And it's about mastering the discipline to wait for the signal that says, now, attack. In this series, you'll walk step by step through that transformation. From the harsh reality that kills most traders to the secret strategies that keep the pros alive. From the minefields of sideways chaos to the Fibonacci compass that shows you where to strike. From Tesla's brutal fake breakout to Bitcoin's dazzling run and pullback, you'll see real battles fought in real markets, where fortunes were made and lost in minutes. This isn't a lecture, this is a war story, and you are the protagonist. Every chapter will hand you not just knowledge, but scars, lessons, and strategies forged in fire. By the end, you'll no longer see charts as random lines. You'll see battle lines, war maps, and opportunities to strike with the calm precision of a commander. So, buckle in, the battlefield is waiting. The question is, will you charge like the rookies who fall in the first volley, or will you learn to move with patience, discipline, and lethal timing? Because the next chapter isn't theory, it's survival. We're about to dive into the one rule that keeps soldiers alive and traders profitable: simplicity. Complexity is seductive. It whispers promises of certainty, of mastery, of having the secret formula that no one else knows. That's why so many rookies bury themselves in indicators, signals, and multicolored charts until the screen looks like a Christmas tree lit up for the holidays. But on the battlefield, complexity kills. When bullets are flying, when the market is swinging, you don't have time to juggle 12 different voices in your head. You need clarity. You need simplicity. I spent years chasing the illusion of the perfect system. RSI, MACD, Bollinger Bands, Ichimoku clouds. I thought if I just combined them all, I'd find a crystal ball. Instead, I found confusion. One indicator shouted buy while another screamed sell. My head spun, my account bled, and I realized I wasn't trading the market. I was trading my indicators. I had turned myself into a soldier staring at the map while missing the ambush right in front of me. Survival begins the moment you strip away the noise. Think of a general on the battlefield. He doesn't need 50 scouts reporting 50 different things. He needs one clear signal, where the enemy is weak, where to strike. In trading, that clarity comes from reading price itself. The market doesn't lie. Indicators are interpretations, but price is truth. A candle closing strong tells you more than any lagging oscillator. A range-breaking clean is louder than any moving average. Simplicity is not about ignorance. It's about precision. It's about knowing which 2 or 3 tools sharpen your vision and discarding the rest. It's about looking at Bitcoin pushing through $124,000 and asking, did it break clean? Did it hold? Or did it collapse back like a fortress too thinly defended? That single question cuts through the noise faster than any cluster of indicators. And here's the hidden gift of simplicity. It breeds discipline. When your chart is clean, your rules are clear, your patience grows. You're no longer looking for reasons to trade, you're waiting for permission. You're no longer gambling, you're hunting. Simplicity gives you the power to say, not yet. And that one phrase will save more of your capital than any stop loss ever could. The irony is that rookies fear simplicity. They think it makes them less sophisticated, less prepared. They want to look like experts with 10 screens flashing colors. But pros know better. Pros can trade from a laptop on a beach because they know what really matters. Market structure, zones, and signals. Everything else is decoration. Imagine being in the middle of a battle, smoke rising, chaos everywhere. Do you want a cluttered map covered in 50 arrows, or a clean sketch that shows exactly where the enemy line is weakest? That's the difference between the trader who hesitates, second guesses, and loses, and the trader who waits, aims, and fires once with precision. Think about Tom Brady in the pocket. He doesn't need 20 different reads. He needs to see the one defender out of position, the one receiver breaking free. That's the power of simplicity. It sharpens your edge and strengthens your patience. And once you embrace it, the battlefield changes. You stop seeing chaos. You start seeing patterns. You start seeing the terrain itself. By the way, if you've ever been overwhelmed by indicator overload, drop a comment below. Tell me which indicator you finally deleted that freed your mind. Sometimes liberation comes from subtraction, not addition. And that's where we're heading next. Because now that you've stripped away the noise, it's time to unfold the actual map of the market, the 4 terrains every trader must recognize before stepping into the fight. Chapter 3. The 4 terrains of the market. Every battlefield has terrain. High ground, valleys, rivers, choke points. A wise general studies the terrain before sending soldiers into combat because terrain dictates strategy. In trading, the terrain is market structure. If you step onto the field without reading the lay of the land, you are fighting blind. There are 4 terrains every trader must master: the advancing front, the retreating collapse, the stable trench, and the chaotic minefield. The advancing front is the uptrend. Imagine an army pushing forward, breaking enemy lines one after another. Each new high is a captured hilltop. The buyers hold momentum, and the sellers are retreating. This is when long trades flourish because the flow of battle is already on your side. When the market opens at 9:30 a.m. Eastern and you see clean higher highs and higher lows, that's your signal that buyers control the field. The retreating collapse is the downtrend. Here, sellers dominate, knocking buyers off one hill after another. Each new low is a fortress falling. This is where shorts thrive because the pressure is relentless. Both the advancing front and the retreating collapse are terrains where direction is clear, the battle lines are visible, and opportunities are ripe if you align yourself with the stronger side. Then comes the stable trench, the sideways market with rules. Picture 2 armies facing each other across a field, neither willing to advance. They dig trenches, set boundaries, and the fight goes back and forth within those walls. The price bounces between support and resistance, forming rectangles or triangles. It's not glamorous, but it's predictable. A skilled trader can exploit these ranges, buying low, selling high, like a soldier firing from behind sandbags. But the most dangerous terrain is the chaotic minefield, sideways with no rules. This is where soldiers get blown apart. The market whipsaws, sweeping both highs and lows, tricking buyers and sellers alike. Stop losses explode like landmines, wiping out entire platoons of retail traders. This is not a field you want to march across. No matter how tempting it looks, chaos consumes even the experienced. The only safe move here is to hold your fire, to step back, and wait until the dust clears. The key insight is simple. Survival depends on terrain recognition. Too many rookies treat every market the same. They try to attack in chaos, defend in collapse, or counterstrike in advancing fronts. No wonder they lose. Pros adapt. They see the terrain, and they change their tactics. They attack only when the ground favors them. Take the summer of 2024. The S&P 500 slipped into a choppy sideways range, breaking highs one day, collapsing lows the next. Retail traders poured in, thinking each move was the start of a trend. Instead, they got shredded in the minefield. Meanwhile, the disciplined generals stayed out, conserving capital, waiting for a true breakout. Trading isn't about always being in battle. It's about knowing which terrain you're standing on. Uptrend, advance with the buyers. Downtrend, press with the sellers. Stable trench, play the bounce. Chaotic minefield, stay the hell out. This is the first step toward fighting like a commander, not a foot soldier, but recognizing terrain is only the beginning. The next question is, what do you do when the terrain is chaos, when the field is riddled with mines and ambushes? How do you protect yourself from the traps that lure most traders to their death? That's where we go next, into the ambush territory of sideways chaos, and the art of avoiding battles you can't win. Chapter 4, Ambush Territory, Chaotic Sideways. On the battlefield, there is no deadlier ground than the ambush zone. It looks calm at first, just a patch of open field, maybe some brush swaying in the wind. But the moment you march your troops in, the ground explodes with hidden mines and arrows rain down from nowhere. That is exactly what the market does in chaotic sideways phases. It lures you with the illusion of stability, then rips your positions apart in seconds. You've seen it. Price moves up just enough to tempt breakout buyers, then slams down and liquidates them. A few candles later, it dips just below the previous low, baiting shorts, only to reverse viciously and take them out too. This isn't a battle. It's a massacre, and the victims are almost always retail traders convinced they've spotted a trend where there is none. In mid-2024, the S&P 500 gave us a perfect example. For weeks it hovered in a narrow band, teasing both sides. One day, headlines declared a breakout to new highs. Traders piled in long. Within 48 hours, the index plunged back into range, wiping them out. A week later, a breakdown headline flashed. Shorts flooded in, only to watch the price rip higher. The market wasn't trending, it was hunting. And the hunters were the big players, running stop sweeps and filling orders while the crowd bled. Chaotic sideways is not the same as a stable trench. In a trench, you know the walls. Price respects boundaries, and you can bounce trades off them. But in chaos, there are no walls, just shifting shadows. Every support breaks. Every resistance fails. It's like fighting in a fog where enemies can strike from anywhere. And just like any foggy battlefield, the smartest generals don't rush in. They wait for visibility. The harsh truth is this: if you keep fighting in ambush zones, you will lose. Even pros step aside. They understand that conserving capital is a victory in itself. Money not lost is ammo preserved for the real battles ahead. Rookies think they need to fight every day. Pros know their edge comes from fighting less, not more. Think of it like this: a soldier who charges into every patch of trees, convinced the enemy is hiding there, won't last long, but a general studies the map. He sees where the land is too dangerous, too unpredictable, and he steers clear. That's not cowardice, it's wisdom. The market rewards patience, not recklessness. Pause for a moment. Think about your worst trading loss. Was it in a clean trend or in choppy, directionless action? If you're honest, it was probably the chop that got you. Comment chop if that resonates. Recognizing this pattern in your own trading is the first step to avoiding it. And here's the deeper insight. Avoiding bad trades is as profitable as making good ones. Every avoided ambush keeps your war chest intact. Every skipped chaotic sideways saves you from emotional wounds that take longer to heal than financial ones. It's not just about money, it's about your mindset. If you've ever blown an account in choppy conditions, you know the shame, the frustration, the "I should have stayed out." That emotional scar can haunt you, making you trigger happy in the next battle, or too timid to pull the trigger when the real opportunity comes. By learning to identify and avoid chaotic sideways, you protect not just your capital, but also your clarity. So, how do you move from fear to opportunity? By seeing real examples of both traps and triumphs. Because theory is one thing, but watching actual battles unfold on the charts is where the lessons truly sink in. That's where we go next, into the case studies that show exactly how the battlefield punishes the impatient and rewards the disciplined. Chapter 5. Case Study. Tesla's Fake Breakout. Every battlefield has its cautionary tale, the story whispered among survivors about what happens when discipline slips. For traders in 2024, Tesla provided one of the clearest examples. The stock approached the $400 level, a fortress wall everyone was watching. Social media buzzed, analysts debated, retail traders crowded the gates. And then, seemingly out of nowhere, Tesla broke through. The breakout looked like victory. The crowd rushed in. But it was a trap. Price pierced the wall, only to stall. There was no decisive candle, no three-phase signal we'll discuss later. It wasn't weakness turning into standoff and then a clean breakthrough. It was noise, hesitation, and then a brutal reversal. Those who bought the breakout found themselves instantly under fire. Their stop losses lined up like soldiers in open field, and the market cut them down one by one. What looked like the beginning of a glorious campaign turned into a rout. This is what we call a false breakout, or as veterans know it, a liquidity hunt. Big players know where the crowd's stop orders are clustered. They push price just far enough to trigger retail excitement, lure them in, and then reverse hard, using their exits as fuel. It's not conspiracy, it's strategy. And Tesla's fakeout was textbook. For the rookies, this was devastating. They had believed the headlines, believed the hype, believed that price-breaking 400 was enough. But markets don't reward belief. They reward evidence. The evidence, the decisive signal, never appeared. There was no strong follow-through candle, no surge of volume confirming conviction. The fortress wasn't captured, it was baited, and the impatient traders walked straight into the ambush. Stock Twits was screaming by. The Wall Street Bets subreddit went wild with rocket emojis. Everyone thought they were early to the party. Instead, they became the exit liquidity for smarter money. The emotional damage was worse than the financial loss. These traders now carry the scar of that betrayal, making them hesitant on real breakouts or reckless, trying to get even with the market. Yet, for disciplined traders, Tesla's move was a lesson and an opportunity. Those who recognized the missing signal didn't buy the fakeout. Some even shorted the reversal, joining the counterattack once the trap was sprung. They understood that battles aren't won by rushing at the first sign of weakness, they're won by waiting until the breakthrough is undeniable. Did you buy Tesla at 400? Type trapped if you've been caught in a similar fake breakout. No shame here, only lessons. Every veteran has scars from these battles. This case study matters because Tesla wasn't an obscure penny stock. It was a global giant, watched by millions. If such a widely tracked fortress can be turned into a trap, imagine what happens in smaller, less liquid names. The principle is universal. No breakout is valid without confirmation. The signal must appear, or you stay out. The emotional lesson here is just as powerful. Watching Tesla reverse taught patient traders the value of restraint. They didn't make money that day by winning a battle. They made money by avoiding slaughter. Sometimes the most profitable trade is the one you don't take. That wisdom separates veterans from rookies. And Tesla's fakeout isn't an isolated story. Across markets, false breakouts appear again and again. But just as some traps destroy, others set the stage for glorious victories. When the false move clears the field and the true signal finally emerges, traders who waited step into some of the cleanest opportunities of their careers. That's exactly what happened with Bitcoin just weeks later. Let me show you how patience turns traps into triumphs. Chapter 6. Case Study, Bitcoin Pullback Buy. If Tesla's fake breakout was a warning, Bitcoin's pullback in November 2024 was the counterpoint, a masterclass in how patience and structure deliver the cleanest trades. Let's set the scene. Bitcoin had just stormed through $120,000, a fortress wall the world was watching. Headlines exploded, social media cheered, and FOMO spread like wildfire. Many rookies chased the breakout at the top, desperate not to miss the move. But generals don't chase. They wait for the army to regroup, and regroup it did. Within days, Bitcoin pulled back, retracing into the 115 to 118,000 zone. To the untrained eye, it looked terrifying. Panic spread as the same voices who screamed new highs now whispered collapse. But traders who knew the terrain saw something else. This wasn't chaos, it was balance. That zone aligned perfectly with key technical levels we'll explore in the coming chapters. It was not just a random pullback, it was a golden opportunity forming. Then came what I call the three-phase signal. First, weakness in sellers. Long wicks at the lows, candles losing momentum, the push-down sputtering. Second, standoff. A cluster of tight-bodied candles, indecision as both sides dug trenches. The air was heavy, waiting for a move. And then third, breakthrough. A decisive green candle ripped above the hesitation zone, bold and unapologetic. That was the trumpet blast. That was the moment to strike. Traders who entered there weren't gambling. They weren't hoping. They were aligning with evidence. Multiple technical factors converge like a general's map, aligning terrain, weather, and supply lines. The result was one of the cleanest long entries Bitcoin had given all year. Meanwhile, what happened to the rookies who chased the breakout at 124,000? They were the wounded retreating from the battlefield, bleeding capital and confidence. Their impatience cost them dearly. The disciplined traders, by contrast, marched in only when the field was cleared, when the enemy had shown weakness, and when the fortress was reinforced. They bought at 115 to 118,000, while others were licking their wounds. This is the difference between gambling and strategy. The gambler believes every breakout is a ticket to riches. The strategist knows that victory comes not from charging at the first sign of glory, but from waiting for the moment when terrain, timing, and confirmation align. Bitcoin's pullback buy was more than just a trade. It was a lesson in patience. It was proof that the market rewards those who wait. And it was a reminder that even in the chaos of crypto, the same ancient principles of supply, demand, and discipline apply. Let's pause here. You've now seen the trap and the triumph. Tesla showed you what happens when you rush in without confirmation. Bitcoin showed you what happens when you wait for the perfect setup. Take a breath. The next section will arm you with the exact tools to spot these setups yourself. We're about to dive deep into the fortresses where these battles are won and lost. Chapter 7. 2. Buyer fortresses in an uptrend. Every army needs strongholds, fortresses that anchor their advance and give them a place to regroup. In the market, buyers also build fortresses. And if you learn to spot them, you'll know exactly where the safe ground lies. In an uptrend, there are two fortresses that matter more than anything else: the origin of the wave and the broken high. The first fortress is the wave's beginning. Imagine the moment when sellers had the upper hand, pressing price down, and suddenly buyers surged, overwhelming them. That starting point is not random. It's the battlefield where the tide turned. When price later pulls back into this zone, it's like revisiting the old battlefield where the buyers first proved their dominance. The memory of that victory makes them eager to defend it again. The second fortress is the broken high. Picture a castle wall that held for weeks, maybe months, and one day the buyers finally smash through. That breach doesn't just mark progress, it marks conviction. It took extraordinary firepower to break that wall. And here's the key. When price pulls back to test that old wall, sellers often try to reclaim it. But the buyers, now emboldened, rush in again, turning the old resistance into fresh support. That old high becomes a fortress of its own. Look at Bitcoin in late 2024. When it blasted through the $120,000 level in November, that old high wasn't just a number on a chart. It was a fortress wall shattered by a massive buyer offensive. A few weeks later, when price pulled back toward 115 to 118,000, that zone became the battlefield again. Sellers tried to press back, but buyers defended their newly captured ground. That defense created one of the cleanest buying opportunities of the year. This is exactly what we saw in our Bitcoin case study. The pullback wasn't random, it was a return to the fortress, and those who understood this dynamic were ready when the signal appeared. This is why understanding fortresses is vital. Too many rookies chase price in the middle of nowhere, entering trades in no man's land where anything can happen. But pros wait for the fortresses. They know that when price returns to these zones, the chances of a strong defense are far higher. It doesn't mean the fortress will always hold. No defense is perfect. But it means the probability is stacked in their favor. Think of it like this. Would you rather fight in the open field, exposed on all sides, or inside a walled stronghold where reinforcements are ready? Buying at random levels is like wandering the open field. Buying at the wave origin or broken high is like stepping into the fortress with your allies. There's another benefit. Trading from fortresses gives you structure for your risk. Your stop loss can sit just beyond the walls, where, if broken, you know the defense has failed. That clarity prevents oversized losses. It's not about being right every time. It's about having defined battlegrounds where your risk is limited and your reward is magnified. So, here's the shift. Stop chasing candles, start identifying fortresses. When you see the origin of a wave or a broken high, mark them. Wait for price to return. Watch how the soldiers line up. Are buyers eager to defend? Or are sellers regrouping for a counterattack? Your job isn't to predict, it's to recognize where the battle is worth fighting. And if these are the strongholds of buyers, what about the enemy? Sellers build their own fortresses too, in downtrends, where their dominance is clearest. To master the battlefield, you need to learn both sides, where buyers anchor their advance and where sellers tighten their grip. Chapter 8. Two seller fortresses in a downtrend. If uptrends are the story of armies advancing, downtrends are the story of armies retreating. And just as buyers build fortresses to protect their progress, sellers construct their own strongholds when they seize control. For a trader, recognizing these bearish bastions is not just about making money. It's about survival, about knowing where danger lies and when opportunity is ripe. The first seller fortress appears when price rallies into supply after a sharp drop. Imagine a defeated army trying to regroup, pushing forward in a counterattack. They advance a little, but the enemy is already entrenched, waiting with cannons loaded. That rally into supply is nothing more than a desperate move into enemy fire. For the trader, this is an ideal zone to join the dominant side. Sellers, fresh and fortified, overwhelm the buyers who dared to step forward. The second fortress lies at the broken low. Think of it as a fortress wall that buyers had defended again and again, until one day it collapses. When that low breaks, the momentum shifts decisively. And when price comes back to retest that broken wall, buyers often try to reclaim it, hoping to rebuild what they lost. But sellers, now in control, storm the breach and reinforce it as their own. What was once a buyer's fortress becomes a seller's stronghold. We saw this play out in 2024 with tech darlings like Nvidia. After an explosive AI-driven rally that pushed the stock to $450, exhaustion set in. When it pulled back into key supply zones around $420, sellers swarmed. Each retest of broken support levels became a textbook example of bears building fortresses. Traders who understood this dynamic didn't see the pullback as a chance to buy the dip. They saw it as an invitation to align with the dominant army. And they profited while dip buyers were crushed. The lesson is simple. In a downtrend, the enemy controls the battlefield. You don't charge against entrenched defenders. You don't fight uphill battles. You wait for price to march back into seller fortresses and you join the defense. This isn't about being smarter than the market. It's about being humble enough to respect momentum and patient enough to wait for the enemy to show their hand. There's something liberating about this perspective. Instead of fearing downtrends, you embrace them. You realize that markets don't have to go up for you to win. Fortunes are made on the short side just as much as the long. The battlefield doesn't care which way you fight. It only rewards those who fight on the stronger side. Here's the truth. Most of you have never shorted. You're fighting with one hand tied behind your back. The market moves down faster than it moves up. Fear is stronger than greed. Are you ready to master both sides of the battlefield? Type both ways in the comments if you're ready to learn the bear side of trading. But here's the danger. Even strong fortresses can fail. Sometimes price breaks through, buyers regroup, and the tide shifts. This is why you can't blindly assume every supply zone or broken low will hold. You must watch carefully, measure momentum, and recognize when the fortress is too weak to stand. That's where our journey takes us next, into the moments when strongholds collapse, when what seemed unbreakable suddenly gives way, and traders who thought they were safe are caught in the rubble. Chapter 9. When fortresses collapse. Every fortress looks impenetrable until the day it falls. In trading, this collapse happens when a level that once held strong crumbles under pressure. For those inside the walls, the fall is sudden, shocking, devastating. For those watching carefully, it's the signal that the tide of battle has turned. There are two ways fortresses collapse in the market, and both carry lessons written in blood and capital. The first collapse happens when price breaks a key level, but the breakout is weak. It slips above resistance or below support just enough to fool the crowd. Then it stalls, gasps, and reverses hard. Traders who jumped in at the first sign of victory suddenly realize they've charged into a trap. This is the false breakout, the moment when what looked like a breach is really a feint. Remember Tesla at 400? That was exactly this type of collapse. The fortress looked broken, but it was a trap. The second collapse is more brutal. It's when price surges so far beyond a level that it looks unstoppable, only to snap back violently. Imagine soldiers storming through a gate, advancing deep into enemy ground, only to realize they've overextended. Supply lines break. Reinforcements can't keep up. the enemy regroups and counterattacks, cutting them down as they retreat. That's what happens when a breakout runs too far, too fast, then reverses with savage force. Take Bitcoin in December 2024. It smashed through the $124,000 fortress like a conquering army. Traders cheered, headlines screamed, the crowd piled in. Twitter was on fire with moon emojis and price targets of 200,000. But then, reality struck. Within weeks, Bitcoin dropped back to 111,000, erasing billions in paper profits. For those who chased the breakout without caution, the collapse was brutal. For those who recognized the danger of overextension, it was confirmation that even the mightiest fortress can be lost. This is why survival depends on humility. No fortress is invincible. No level is sacred. When you treat every breakout as gospel, you set yourself up for ruin. But when you watch for signs of weakness, stalling candles, heavy wicks, exhausted momentum, you prepare yourself to step aside, or even switch sides, before the walls come crashing down. The hardest part for traders is emotional. You want to believe the fortress will hold. You want the breakout to be real. You want the trend to continue because you've already imagined the profits. But the market doesn't care about your wants. The market only shows you footprints in the sand, momentum rising or momentum fading. If you ignore those footprints, you get buried under the ruins. Here's the deeper truth. Collapsed fortresses create opportunity. A failed breakout traps the crowd. Their stop losses and liquidations become fuel for the other side. If you stay patient, if you don't get lured into the initial move, you can profit from the counterattack. It's not about predicting, it's about reacting with discipline when the walls give way. So next time you see a fortress under siege, don't rush in with the mob. Watch, study, ask, is this a true breach or a feint? Are the attackers overextended? Is momentum waning? When the collapse comes, you won't be buried with the rookies. You'll be the one seizing the ground they left behind. But how do you measure when a fortress is collapsing from weakness or overextension? How do you avoid guessing and instead anchor your decision in balance? That's where the general's compass comes in, the timeless tool that shows you whether a move is stretched too far or perfectly measured. Chapter 10. Fibonacci, the general's compass. On every battlefield, generals carry a compass, not because they don't know where they are, but because they need to measure distance, how far the army has advanced, how far it must retreat, and where balance lies between overextension and collapse. In trading, that compass is Fibonacci. It doesn't predict the future. It doesn't magically move price. What it does is measure balance, and balance is the difference between a breakout that holds and one that collapses. Here's the principle. After a strong advance, price often pulls back before continuing higher. But how deep should that pullback go? Too shallow, and the buyers haven't had time to regroup. Too deep, and the defense might crumble. Fibonacci levels, especially the 0.5 and 0.618 retracements, mark the sweet spot. They represent the zone where the move is balanced, not weak, not overextended. It's like marching just far enough to stretch your lines, but not so far that you snap them. Take Bitcoin's charge past 120,000 in November 2024. When it pulled back into the 115 to 118,000 zone, guess what? That area lined up almost perfectly with the 50 to 61.8% retracement of the prior surge. It wasn't coincidence, it was balance. And when buyers stepped in to defend that zone, the compass proved its worth. Those who waited for the retrace instead of chasing the breakout entered from a fortress reinforced by equilibrium itself. This is exactly what made our Bitcoin case study so clean. The pullback wasn't just to a fortress, it was to a fortress aligned with Fibonacci balance. Multiple forces converged on the same battleground. This is why pros love Fibonacci. It's not about mysticism or sacred numbers. It's about structure. It gives you a measured way to judge whether a move is sustainable. Think of a soldier sprinting into enemy territory. If he runs 20 feet and pauses to regroup, he's still strong. If he runs 200 feet without stopping, he's vulnerable. Fibonacci measures those distances for you. It tells you whether the army has paused in balance or sprinted into exhaustion. But here's where rookies go wrong. They slap Fibonacci on every chart, every time frame, like a magic wand. That's not strategy, that's superstition. The compass is only useful when aligned with real terrain. You must match Fibonacci with strongholds, the origin of waves, the broken highs or lows. When the retracement overlaps those fortresses, the zone becomes golden. That's not luck, That's multiple forces converging on the same ground. Think of it as a general choosing where to build a camp. He doesn't just pick a random field. He looks for a spot near water with defensible terrain, aligned with supply lines. Fibonacci is one of those alignments. Alone, it's just a number. But when it reinforces a fortress, it becomes a strategic position worth defending. This reminds me of Warren Buffett's approach to value investing. He doesn't just look at one metric. He waits for multiple factors to align: price, value, momentum, timing. That's exactly what we're doing with Fibonacci and fortresses. We're stacking probabilities, not gambling on single indicators. We're deep in the tactics now. If you're still here at the 45-minute mark, you're serious about transformation. The final push ahead will cement everything into actionable discipline. Because even when you find the perfect retrace, you can't fire too early. You need the signal, the clear order to attack. Chapter 11. The 3 phases of a signal. On the battlefield, no army charges without a signal. A trumpet blast, a drum beat, a flag raised high, something that says, now, attack. In trading, the signal is just as crucial. Without it, you're firing into the fog, wasting ammunition, exposing yourself to ambush. With it, you strike at the exact moment when the odds tilt in your favor. Every great trade rests on recognizing this 3-phase signal. Phase 1 is weakness. Before victory, you must see the enemy falter. In the market, that looks like sellers losing steam in an uptrend, or buyers running out of breath in a downtrend. Candles leave long wicks. Momentum slopes flatten. Price moves forward like an army dragging heavy legs, slower and slower. This is the first clue. The defenders are tiring, and the battle may soon swing. Phase 2 is the standoff. Both sides dig in. Neither is advancing, neither is retreating. On your chart, this appears as a cluster of small-bodied candles, short ranges, sideways hesitation. To the untrained eye, it looks like nothing. But to the general, it's the pause before the storm. The armies staring across the field, testing each other's resolve. In this moment, patience is your weapon. You don't fire yet, you wait. Phase 3 is the breakthrough. After weakness and standoff comes the decisive strike. A candle rips through the hesitation zone, big and bold, cutting across the field with conviction. This is not a whisper, it's a roar. It tells you the stronger side has seized control, and the path forward is open. That single decisive candle is the trumpet blast, the flag raised. It's the moment to fire. Remember our Bitcoin pullback? This is exactly what formed. Weakness in sellers at the lows, then the standoff with tight candles, then the breakthrough that confirmed the buy. Without all 3 phases, there was no trade. This pattern, weakness, standoff, breakthrough, repeats across markets, timeframes, and assets. Whether it's Bitcoin pulling back into a fortress, Tesla faking out retail traders, or the S&P shifting after weeks of chop, the signal looks the same. 3 phases, 1 story, the weak side falters, the field goes quiet, the strong side storms in. Most traders lose because they ignore the signal. They enter at phase 1, assuming weakness means reversal. Too early, they enter at phase 2, stuck in the standoff. They get chopped. Or worst of all, they jump before any of the phases form, gambling in no man's land. The result? Stop losses hit, confidence shattered, accounts drained. The disciplined trader waits for all 3. Weakness shows the enemy is vulnerable. Standoff proves the ground is contested. Breakthrough confirms who won. Only then do you step in, aligned with the victor. This patience doesn't just increase your win rate, it saves you from countless bad trades. Here's your homework. Pull up any chart right now. Find the last big move. Can you spot the 3 phases before it happened? If you can train your eye to see this pattern, you'll never trade the same way again. Share your findings in the comments. Which phase do you usually enter too early? Think of generals through history. The wise ones didn't charge at the first sign of weakness. They watched. They waited until the defenders not only faltered, but also gave ground. Only when the breakthrough was undeniable did they unleash their troops. That discipline is why their armies survived. That discipline is why your account will too. But what happens if you pull the trigger before the signal? What happens when impatience overpowers discipline? The answer is written across countless failed trades. Chapter 12. Why pulling the trigger? Too early gets you killed. On a battlefield, nothing is more dangerous than a soldier who panics and fires before the order. The flash of his musket alerts the enemy, the chaos spreads through his own ranks, and suddenly the entire formation is compromised. In trading, impatience works the same way. When you pull the trigger before the full signal forms, you aren't seizing opportunity, you're stepping into your own ambush. At any fortress, be it a key support or resistance zone, 3 outcomes exist. First, price touches the zone and reverses cleanly. That's the win everyone dreams of. Second, price fakes the reversal, whipsaws through, and then comes back. That's the trap that wipes out early entries. Third, price plows straight through the zone, fortress walls collapsing as if they never existed. 2 out of 3 outcomes are against you if you don't wait for confirmation. Do you really want to gamble with those odds? Remember Tesla at 400? Those who entered before the 3-phase signal got destroyed. They saw the fortress and assumed it would hold. But assumptions aren't evidence. Evidence is the completed signal, all 3 phases present and accounted for. Impatience doesn't just cost money, it corrodes your mindset. Every early loss plants seeds of doubt. You hesitate on the next trade, second-guessing yourself. Or worse, you chase recklessly, trying to win back what you lost. Both outcomes lead you deeper into the enemy's traps. One bad entry snowballs into emotional warfare that can wreck weeks of progress. Patience, by contrast, is armor. It shields you from unnecessary wounds. It doesn't make you invincible, you will still lose sometimes, but it ensures you only fight battles worth fighting. A patient general doesn't send troops charging at every glimmer of weakness. He waits until the enemy is not just faltering, but fully exposed. That discipline preserves his army. That same discipline preserves your capital. And here's the paradox. By trading less, you actually profit more. By skipping uncertain setups, you keep your war chest full for the moments that matter. The big moves, the Bitcoin pullback into fortress support, the Tesla post-fakeout rally, the S&P after breaking free of a chaotic range, these are the campaigns that define your year. And you only capture them if you're alive, patient, and ready when the signal arrives. Think about the pattern day trader rule that restricts accounts under $25,000. Some see it as a limitation. Smart traders see it as forced discipline. It prevents you from overtrading, from fighting every skirmish. Sometimes constraints are blessings in disguise. So, the next time your finger hovers over the buy or sell button too soon, remember this. You are not just risking money, you are risking position, clarity, and discipline. Every bullet fired early is a bullet wasted. Every trade forced without confirmation is a step closer to ruin. The battlefield rewards patience. The generals who wait for the exact moment strike with precision, crush their enemies, and preserve their armies. The rookies who rush in are buried under the dust of their own impatience. But winning individual battles isn't enough. You need to manage your campaigns, protect your gains, and know when to retreat. Chapter 13. Trade management like a general. A battle isn't won the moment you charge. Victory is secured when you know how to advance, when to retreat, and how to protect your forces in the chaos that follows. In trading, entering a position is only half the fight. The other half, the half that decides whether you walk away victorious or wounded, is trade management. Imagine a general pushing his troops into enemy territory. Does he let them run blindly until exhaustion sets in? Of course not. He sets objectives: capture the hill, secure the bridge, hold the line. In trading, your objectives are your profit targets, measured in R multiples, 2R, 3R, sometimes more. These targets are not random dreams. They're milestones that tell you how far to push before regrouping. When you hit them, you don't get greedy. You secure the ground you've taken. You lock in the win. Then there's the matter of retreat. No fortress holds forever, and no trade goes straight to profit. That's why we play stop losses. But stop losses aren't just safety nets. They're strategic retreats. When you enter at a buyer fortress, your stop sits just beyond the walls. If it's breached, you know the defense failed. That's not defeat, that's wisdom. Better to retreat with a fraction of your forces than be annihilated. And what about when the battle evolves? Sometimes you capture a hill and see an opportunity to push further. That's when you move your stop, what traders call trailing. Think of it as shifting your supply lines forward. Each step locks in more territory, protecting your gains while leaving room to advance. But discipline is key. Move your stop too fast and you strangle your troops. Move it too slow and you risk losing hard-earned ground. Balance is everything. One of the greatest dangers on the battlefield is overconfidence. After a clean win, traders often double down recklessly, thinking they're invincible. But generals know that every victory can be followed by an ambush. That's why they protect their supplies, rest their soldiers, and prepare for the next fight with the same caution as the first. In trading, this means respecting risk per trade, never over-leveraging, and remembering that one battle does not decide the war. The story of Bitcoin's pullback buy illustrates this perfectly. Traders who manage their position like generals, setting clear profit targets, moving stops strategically, walked away with significant gains. But those who got greedy, expecting the advance to never end, often gave back their profits when the market reversed. They forgot that discipline doesn't end at entry. It must last until the final candle closes. Trade management is not glamorous. It doesn't light up social media like a flashy entry call, but it is the quiet discipline that keeps armies alive and accounts intact. And if you master it, you'll understand something most traders never do. The goal is not just to win trades, but to survive campaigns. Because on the battlefield of markets, it's not the soldier who wins the most battles who endures. It's the one who avoids the wrong battles entirely. Chapter 14. Battles you should never fight. Every general knows there are fights not worth the blood, skirmishes that drain resources, battles fought on ground too treacherous to hold, traps designed to lure the overconfident into disaster. For traders, these are the setups you must learn to skip: the chaotic sideways markets, the half-formed signals, the zones already breached and weakened. These are the battles that kill more accounts than any losing streak of clean trades ever could. Look at meme stocks in 2024, AMC, GME, and their penny stock cousins. The charts became circus arenas. One day they shot up on Reddit hype, the next they collapsed just as fast. Rookies jumped in, believing they could outpace the madness, only to find themselves shredded by whipsaws and liquidity hunts. What looked like opportunity was actually a slaughterhouse. This is the trap of needing constant action. Rookies believe they must always be in a trade, that sitting still means falling behind. But generals know better. Marching into every skirmish burns through supplies long before the decisive battle arrives. In trading, every unnecessary entry erodes your capital and weakens your psychological armor. By the time the real opportunity comes, you're too wounded, financially and emotionally, to seize it. Here's the irony. Skipping trades feels like doing nothing, but it's actually an act of discipline. Each skipped ambush is money saved, patience preserved, clarity maintained. Think back to the S&P 500's choppy summer of 2024. Many retail traders blew accounts trying to guess the direction of each fake move. The pros? They sat back, waited for the fog to lift, and conserved ammunition for the clean breakout that came later. The difference wasn't intelligence, it was restraint. There's another kind of battle to avoid, the one that tempts you emotionally but lacks structure technically. A gut feeling trade, a hunch, a setup where maybe phase 1 weakness appears, but no standoff, no breakthrough. It's like seeing smoke on the horizon and charging without checking if it's actually the enemy or just the wind. These battles rarely end well. Take a moment right now. Think about the trades you took last week. How many were crystal clear setups versus how many were forced because you needed to trade? If you're brave enough, share your ratio in the comments. Awareness is the first step to change. Survival in trading doesn't come from fighting every day. It comes from choosing your battles with surgical precision. Avoiding the bad fights is just as important as winning the good ones. And once you embrace that truth, you step into the final transformation, not just as a survivor of the battlefield, but as a disciplined warrior capable of thriving in any campaign. Because the last chapter is not about setups or signals, it's about who you become. Chapter 15, The Disciplined Warrior. Every war has its heroes, not the ones who charge recklessly into gunfire, but the ones who endure, who outlast, who fight with discipline long after others have fallen. In trading, the disciplined warrior is that hero. He doesn't win because he knows every secret indicator or follows every hype headline. He wins because he masters himself. Think about the traders you've met or read about. The ones still standing after years, even decades. They all share one trait: patience backed by discipline. They treat trading like a campaign, not a single battle. They know that survival isn't about catching every move, but about protecting their capital for the moments that truly matter. They wait for the fortress, they wait for the signal, they wait for the field to tilt in their favor. Becoming that disciplined warrior means rewiring your mindset. It means seeing losses not as shame, but as the cost of doing battle, as long as they're controlled, measured, within the limits you set before stepping onto the field. It means accepting boredom as part of the process, because sometimes the smartest move is to stand still while the chaos rages around you. And it means holding fast to your rules even when your emotions beg you to break them. Backtesting is your training ground. Every chart you study, every historical trade you replay, is a drill that prepares you for the live battlefield. Risk management is your supply line. Without it, no matter how brilliant your strategy, your army starves. Patience is your shield. It protects you from FOMO, from panic, from the enemy inside your own mind. Put these together, and you stop being a rookie. You become a commander. The truth is, trading mastery isn't about predicting markets. It's about mastering yourself. The market is a storm, unpredictable, violent, indifferent. You cannot control it, but you can control your reactions. You can control your discipline. You can control your patience. And in that control lies freedom. This reminds me of something Paul Tudor Jones once said. The secret to being successful from a trading perspective is to have an indefatigable and an undying and unquenchable thirst for information and knowledge. But I'd add to that. It's not just the thirst for knowledge. It's the discipline to apply it consistently, especially when your emotions tell you otherwise. So, picture yourself 1 year from now, 5 years from now, 10 years from now. Do you want to be the rookie still chasing every flicker, still bleeding in chaotic ambushes, still praying for luck? Or do you want to be the disciplined warrior, standing tall with a full war chest, scars on your armor, but clarity in your eyes? The choice is yours. This entire journey has been about preparing you for that choice. You've learned to read terrain, to identify fortresses, to wait for signals, to manage your campaigns, and to avoid unwinnable battles. Now comes the final step, embodying the discipline that ties it all together. Because in the end, markets reward discipline, not adrenaline. They reward patience, not speed. They reward the warrior who knows when to fight, when to wait, and when to walk away. And if you take these lessons to heart, you won't just survive the battlefield, you'll thrive in it. Now, as we close this campaign, the question is no longer, will you survive? The question is, are you ready to lead yourself with discipline, to become the warrior who outlasts and outsmarts the chaos? Because the war never ends. The market opens again tomorrow at 9:30 a.m. Eastern. The pre-market starts even earlier, and the disciplined warrior never sleeps. Your mission starts now. If you've made it this far, you already know this isn't just a story about trading. It's a story about you. You've walked through the battlefield. You've seen the ambushes that slaughter rookies. You've stood in the fortresses that protect profits. You've felt the sting of false breakouts and the triumph of disciplined entries. And you've heard the call to transform, not into a gambler chasing noise, but into a warrior who survives, adapts, and wins. So, here's your mission. Don't let this just be another video you watch and forget. Take one lesson, just one, and put it into action today. Maybe it's marking out the 4 terrains on your chart. Maybe it's refusing to trade in chaotic chop. Maybe it's waiting for the 3-phase signal before pulling the trigger. Pick one and let it harden into discipline. Because discipline is not built by thinking, it's built by doing. Tonight, when the futures market opens, or tomorrow when the bell rings, you have a choice. Enter the battlefield as the same trader who started this video, or step forward as someone who finally sees the terrain clearly. Open your charts right now. Mark just one fortress from recent price action. Don't trade it yet. Just observe how price respects or breaks it over the next few sessions. This single act begins your transformation. If this message struck you, then you know you're not alone on this battlefield. There are thousands of us walking the same path, learning the same painful lessons, fighting the same inner wars. And together, we can share scars and strategies, victories and defeats. That's what Trading Psychology Stick is about. Building an army of disciplined warriors who refuse to be retail casualties. So, here's what I want you to do right now. Hit subscribe, because this is just the beginning of the campaign. Every week, we dive deeper into the psychology, the patterns, the discipline that separates the 10% who survive from the 90% who don't. Drop a comment below and tell me the one battle you keep losing, whether it's chasing breakouts, overtrading, or cutting winners too early. Say it out loud. Type it out. Because once you name the enemy, you can start to defeat it. And if you're serious about transformation, add the word warrior to your comment. Let's see who's ready to stop being a casualty and start being a commander. Share this video with someone you know who keeps getting wrecked by the market. You might just save them from another ambush. Send it to that friend who messages you every time they blow up their Robinhood account. Send it to that colleague who thinks trading is just gambling. Send it to anyone who needs to hear that there's a better way than bleeding out in the chaos. This war doesn't end. The market opens tomorrow, next week, next year. But every day you step onto the field with more clarity, more patience, and more discipline, you become stronger. One trade at a time, one decision at a time, you carve yourself into the kind of trader who not only survives, but thrives. Remember this: the disciplined warrior outlasts. The market rewards restraint. And your greatest edge isn't an indicator, a secret formula, or a magic setup. It's you. Your patience, your discipline, your ability to wait for the perfect strike. So, step forward. Arm yourself with these lessons. Join the ranks of those who endure. And never forget, the next battle is always coming. The only question is, will you face it as a rookie or as the warrior you were meant to be? The market opens in less than 16 hours. Your transformation starts now.